Did you know that if you invested just 5 a day from the age of 25, by the time you hit 65, you could have over 600,000? Yes, you heard that right. With the power of compounding, what starts as the price of your daily coffee can transform into a treasure chest by the time you retire. This isn't a magic trick. It's the magic of compounding interest, a secret that has built fortunes and changed lives. Welcome to our journey through the world of compounding, where we unlock the secrets to growing and multiplying your money. It's a path less traveled, not because it's difficult, but because many don't realize its potential. Imagine turning your spare change into a mountain of gold simply by letting time and interest work their wonder. In this series, we'll explore how starting early, choosing the right investments, and sticking to a plan can create wealth you never thought possible. From the basic principles of compounding to advanced strategies like reinvesting dividends, we'll show you how to make your money work for you, not the other way around. So, are you ready to see how the everyday can become extraordinary? How patience and discipline can lead to prosperity? Stay tuned, because we're about to embark on a journey that could change your financial future forever. Let's unlock the power of compounding together. Chapter 1. The Magic Behind Compounding. An Introduction. Have you ever wondered how your money could work for you, even while you sleep? Welcome to the world of compounding, often referred to as the eighth wonder of the world by none other than Albert Einstein himself. But what makes compounding so magical? Simply put, it's the process where the earnings on your investments, be it interest or dividends, earn their own earnings. Over time, this cycle creates a snowball effect, growing your wealth exponentially. The concept of compounding isn't new. In fact, it dates back to the 17th century, introduced by mathematicians who were fascinated by how numbers could grow by themselves. But it's not just about mathematics. It's about patience and vision. Imagine planting a tree. Initially, growth is slow, but as it matures, one tree turns into a forest. That's compounding at work. At its core, the formula for compound interest is straightforward. A once P1 yar NA NT, where A is the amount of money accumulated after N years, including interest. P is the principal amount, the initial sum of money. R is the annual interest rate. N is the number of times the interest is compounded per year. And T is the time the money is invested for in years. Let's break this down with an example. If you invest $1,000 at an annual interest rate of 5% compounded yearly for 20 years, you'd end up with about $2,653.30. But if that interest were compounded monthly, you'd see a bit more growth, ending up with about $2,712.64. It shows how slight adjustments in the frequency of compounding can impact your investments over time. Now, why should you care? Because understanding compounding is the first step towards financial independence. It teaches you not just to save, but to invest wisely. With compounding, time is your best friend. The earlier you start, the more significant the benefits. It's not just about making money, it's about making your money multiply. And that, my friends, is the true magic of compounding. Chapter 2. Setting the Foundation. Start early and invest regularly. You've probably heard the saying, the early bird catches the worm. In the realm of compounding, this couldn't be more true. Starting early gives your investments the maximum amount of time to grow, leveraging the power of compounding to its fullest potential. But it's not just about starting early, it's also about consistency. Regular investments can significantly enhance the compound effect, turning small, consistent contributions into substantial wealth over time. Why does starting early make such a difference? It's all about giving your money more time to compound. For instance, if person A starts investing $200 a month at age 25 and person B starts doing the same at age 35, both earning an average annual return of 7% by age 65, person A will have amassed over $528,000, while person B will have just over $244,000. The 10-year head start nearly doubles person A's investment, showcasing the profound impact of starting early. But how do you start? First, focus on creating a habit of saving and investing. It doesn't matter if you're starting with $50 or $500 a month. The key is consistency. Automating your savings can help. Many banks and investment platforms allow you to set up automatic transfers from your checking account to your savings or investment account, ensuring you regularly contribute without having to think about it. Moreover, it's crucial to increase your contributions over time. As you advance in your career and your income grows, consider boosting your monthly investments. Even a small increase can significantly affect the long run, thanks to the compounding effect. Understanding and leveraging the power of compounding requires patience and foresight. It's about seeing the big picture and recognizing that the financial decisions you make today can profoundly impact your future wealth. Remember, compounding isn't just about mathematics, it's a mindset. By starting early and investing regularly, you're not just saving money, you're setting the stage for financial freedom and security in the years to come. Chapter 3. Choosing the right investment vehicles. Navigating the vast ocean of investment options can be daunting, but choosing the right vehicles is crucial for harnessing the power of compounding. Whether you're a cautious saver or a bold investor, understanding your options can make a significant difference in your financial journey. Stocks are often the go-to for those seeking growth. Investing in companies through the stock market offers potential for high returns, especially for long-term investors. Compounding comes into play as you reinvest dividends and capital gains, accelerating the growth of your investment. However, stocks can be volatile, requiring a stomach for risk and a strategy for diversification. Bonds, on the other hand, offer a more stable investment, providing regular interest payments. While they typically offer lower returns than stocks, bonds can be an essential part of a balanced portfolio, offering regular income and reducing overall risk. Mutual funds and ETFs, exchange-traded funds, allow investors to pool their money to invest in a diversified portfolio of stocks, bonds, or other assets. These funds are managed by professionals who make the investment decisions for you, making them an excellent option for those who prefer a hands-off approach. The power of compounding works as earnings from the fund are reinvested, increasing your investment over time. Retirement accounts such as 401ks and IRAs offer tax advantages that can significantly enhance the compounding effect. Contributions to these accounts may reduce your taxable income, and the investment grows tax-deferred until retirement. In some cases, employers match contributions to 401ks, providing an additional boost to your investment's growth potential. The key to choosing the right investment vehicle is to understand your financial goals, risk tolerance, and the time horizon for your investments. Diversifying your portfolio across different asset classes can reduce risk and take advantage of the growth potential in various market sectors. Remember, the goal is not just to invest, but to invest wisely, allowing the power of compounding to work in your favor. Chapter 4. Understanding risk and return. The relationship between risk and return is a fundamental concept in investing. Generally, the higher the potential return, the higher the risk. Understanding this trade-off is crucial for leveraging the power of compounding effectively. High-risk investments, like stocks, can offer substantial returns but come with the volatility of market fluctuations. On the flip side, low-risk investments such as bonds or savings accounts provide more stability but lower returns. Balancing these options according to your risk tolerance and investment goals is key. One strategy to manage risk while maximizing returns is asset allocation. This involves spreading your investments across various asset classes to reduce risk. For example, a mix of stocks, bonds, and real estate can protect against the downturn of any single investment. Another critical aspect is the concept of time horizon. The length of time you plan to hold an investment can significantly impact your risk tolerance. Generally, The longer your investment horizon, the more risk you can afford to take, as you have more time to recover from potential losses. This is where compounding shines. A longer investment period allows the compound interest to grow exponentially, turning even small investments into significant sums over time. Risk can never be eliminated, but it can be managed. Diversification, proper asset allocation, and understanding your personal risk tolerance are essential steps in crafting a strategy that lets compounding work its magic. Remember, the goal of investing is not just to accumulate wealth, but to do so in a way that aligns with your financial goals and risk tolerance. Chapter 5. Advanced Strategies: Reinvesting Dividends and Interest. When it comes to accelerating the power of compounding, one of the most effective strategies is reinvesting dividends and interest. This technique involves taking the earnings from your investments and immediately using them to buy more shares or units of the investment rather than taking them as cash. This strategy can significantly increase the growth rate of your investment over time. Let's look at dividends, for example. When a company makes a profit, it can choose to distribute a portion of those profits to its shareholders in the form of dividends. If you reinvest those dividends by purchasing more shares, you increase the number of shares you own, which means you will receive even more dividends in the future, assuming the company continues to perform well. Over time, this reinvestment can lead to an exponential increase in the value of your investment. Interest from bonds or savings accounts works similarly. By reinvesting the interest you earn, you're essentially earning interest on your interest, which can significantly boost your total returns over time.